So since I've been doing this show, I'm getting more and more emails from people asking me the question, how do I learn to analyze these companies like you do? And it's very difficult to teach the experience that I've collected over the years on analysing companies, teaching how to read financial statements and stuff like that over emails, certainly over YouTube. It can't really be done. So what I've done is I created a video guide, a video course on how I do it, what I look for, how I interpret the financial statements. There is a fee involved because I spent a lot of time putting that together, and also the return on investment is huge, right? So if I teach you how to do this, and you can identify these companies, invest in great companies on your own, get out there and make a ton of money on it, then really you should probably pay something towards that, I would say. So I've put a course together. If you're interested in it, awesome. Best thing to do is to click the link in the description below, take you to further information where you can swat up on it a bit more, maybe even drop me a line if you want to chat about it. Otherwise, if you're not interested whatsoever, then just ignore everything I've just said. Hey there guys, welcome to the FTSE Show. This is the show where we dissect and analyse UK companies, UK only, because I still keep getting requests to analyse completely foreign stocks. Listen, I totally have plans to do foreign stocks in the future. Absolutely. I want to look at Norway, I want to look at Belgium, I want to look at Sweden, I want to look at Finland, all of these companies. I want to look at America, I want to look at Australia. And I've slowly building up this team of people that are going to help me achieve that. But it's still early days, and we've still got the whole of the FTSE AIM to analyse. We're talking about 700 companies in there. So we are slowly making our way through these companies and identifying all the time. I mean, literally this week we've found 3 more companies that we love the look of, that we're looking at the annual reports right now, and everything's looking awesome, and we're very excited to start looking at potentially investing in them in a few days time. And that's what me and my team work on now. We're looking at finding these tiny small companies. We've done the FTSE 100, we've done the 250, we're pretty much finishing the small cap, and we're looking at the AIM markets and the FTSE fledgling markets, and we're finding these little companies that we've never heard of that are just ticking all the boxes, and they're smashing their numbers. And some of these are very small companies, but they're just doing it very well. They're very efficient. All the spreadsheets are green, the returns are huge, and so these are the companies we're interested in, and we've still got probably 700 companies we haven't even got to yet, and just in the UK alone. But once we've done that, then it's just a case of maintenance, right? Once we've found all these companies, then it's a case of, well, which ones do we know are fantastic investments right now? Let's keep an eye on them, of course. Let's invest in them. But we're also looking at the companies that are really close to being those kind of companies. And we're going to be, every annual report coming out, we're going to be jumping on that the day it comes out, and we're going to be analysing it, see what impact it has on the numbers that we've already looked at, and potentially looking into seeing whether or not it's going to reach the watch list that we use of stocks. And so we'll be promoting these companies. Their scores will be going up, other scores will be going down, but that is a much easier job once you've analysed every company. And so by the end of this year, we'll have all the UK companies done. The FTSE Show would have covered every single company, not necessarily this YouTube show, because we can only hit about 100 companies per year on a 2 per week basis on this channel. But me and my team and what we work on, we'll be hitting all the UK companies by the end of this year. Everything would have been done. And we'll basically get to the point then where we can start looking at other countries. Maybe I'll be recruiting some more people in as well, so we can hit a couple more countries at the same time. Very excited about the future. Very excited about finding some tiny little Norwegian stock perhaps that are absolutely smashing it. Very excites me very much, and that's the kind of thing that certainly I want to be doing going forward in the future. But yeah, so that's something that we're working on, but right now it's just a FTSE Show, and we're looking at a company today called Luceco. I think you pronounce it Luceco, maybe Luceco, I don't know. But these guys are a lighting company. The EPIC code is LUCE, and yeah, they're looking pretty good on face value. So let's dive into those numbers and see what we're dealing with. Okay, so we're taking a look at Luceco, EPIC code LUCE. These guys are in the FTSE Small Cap Index, and they're in the electronic and electrical equipment sector. These guys are a manufacturer and producer of lighting. And as you can see, revenue-wise, there's been some obvious growth since their float in, I think they actually floated in 2017. They actually floated in 2016. 2016 they floated on the London Stock Exchange, so these 4 years are kind of post-float, and 2015 will be pre-float. But we've definitely seen some revenue growth over that period of time, over the 5 years data that we do have, which is great, from 103 million in 2015 to the 172 million that we see in 2019. So some strong growth there, which is great to see. Cost of sales has fallen, it would seem. So from 2015 to 2018, we're looking at about 30% gross margin a year, which is all right, pretty average, to be fair. Not terrible, but not great either. And then that's risen in 2019 to 37.5%. So it's risen by about 7.5%. And what we've actually seen is revenue go up in 2019, but the cost of sales go down in 2019. So that's left them with a higher amount of gross profit and obviously a higher percentage of gross margin as a result of that. So that's good to see. It means gross margin is moving in the right direction. Like I say, 2015 to 2019, pretty flat every year, running at about an average of about 30%. But 2019, we've seen a bit of a jump in revenue and a fall in the cost of sales for this business. Could be a fluke year, could just be a really good 2019 for them. It would be interesting to see if that continues going forward. But based on the information we have now, that's a positive sign. Looking at expenses, historically over the last 5 years, they've been sitting at just shy of around an average of about 70% a year, which we would be happy with. However, in 2018, we saw the expenses jump to 90% of the revenue. 90% of the gross profit. And so that is going to hamper their results for sure for that particular year. But in 2019, we seem to have reverted back to the average of about 70% expenses. So not quite sure what was going on there, but we seem to have seen a spike in expenses in 2018, and then that's kind of stayed level. So essentially what's happened is expenses spiked in 2018, which cost them quite a bit of their profit. They ended up the year not doing particularly well, and we'll come to that in a moment. And then in 2019, expenses stayed at the same level. So we're talking about 44 million a year over the last 2 years. But because revenue went up and cost of sales went down, the percentage of the expenses against the gross profit actually fell, despite the actual financial value of those expenses staying at the same, because the revenue that comes in went up, if that makes sense. So the percentage of that revenue is less. So it looks like percentage-wise they're playing at levels that we would be comfortable with, which is good. Looking at the interest on debt, however, that looks a little bit high. Just a bit too high for us, and it'll be interesting when we get to the balance sheet to see what the long-term debt hold is for this particular company, because that's a concern for me. They're losing 15% of their operating profit just on interest on debt alone, so that's hampering the potential profits they could be making. And then when we come down to the actual net earnings, so 2015, 2016, 2017, all at about 5-6% a year, which unfortunately is not enough for me. And in 2018 they made 0.9%, and that was because of that spike in expenses we talked about, where they had 90% of their gross margin or gross profit eaten up by expenses. Big spike in expenses. And this is why I don't like buying companies and investing in companies, especially smaller companies like this in the small cap, but any company really, where they're trading on very, very tight margin, because all you need is a spike in something, a spike in a liability of some kind, whether it's expenses, wages, whatever. And that can completely eradicate any of your profits. When you're trading at such a tight margin, all you need is a big tax bill to come along, perhaps, and it can wipe out your profit for that year. And I don't like that. And share prices don't like that. Investors tend to kind of run away when the company makes a losing year. And so when you've got a company like Luceco, I think I'm pronouncing that right, Luceco, they're making about 5-6% a year. That's okay. I would go absolutely nowhere near a company making sort of 3-4-5% a year. I mean, it's just too low for me. And we see this evidenced in 2018 with this company, where the expenses spiked up and they only made 0.9% profit that year, 1.5 million out of the 164 million revenue. They only kept 1.5 million of that, or 0.9%. And had that expenses been up higher by another million, had it jumped up 11 million instead of 10 million, that would have wiped out all their profits that year. So they were lucky to make at least 0.9%, I think. And so this is a prime reason why I don't like companies on tight margins, because all it takes is a little expense to come along that they weren't anticipating, or a change in the sector that they work in that's caused costs to rise, or whatever it could be, and it can eradicate any profits. Now in 2019 we've seen a big recovery. Remember I said revenue's gone up, cost of sales has gone down, expenses have stayed the same, and it's all looking a lot better in 2019, so they've had a good year. And as a result of that, what we've seen is that the net earnings for the company went up to 7.6%, so it's grown from the kind of average 5-6% we saw in the first few years since floating on the exchange. Then they had that bad year in 2018 where they made just shy of 1%, and then we've just reverted back and in fact had their best year yet at 7.6%. Now 7.6% is still not good enough for me, still not a company that I would probably be invested in. I'd want to see several years at a much higher percentage rate than that, and I'd need to see several years of consistency so I knew it wasn't a fluky year, if you know what I mean. But at 7.6%, they're not quite what I'm looking for, but it's definitely positive. It's definitely moving in the right direction despite that losing year in 2018, and this is a company that's certainly growing, and the numbers are looking better and better every year, so they've got that certainly on their side. Looking at the balance sheet, they've only got 1.4 million in cash, so they're not very cash rich, which coming into 2020 may have been a bit of an issue for them. But let's take a look. The current ratio is very healthy at 1.8, so they've got essentially almost double the short-term assets against short-term liabilities, which is what we want to see. That's nice and healthy. Looking at the asset value, that's not growing. The assets of the company were sitting at 109 million in 2016. It's now 2019's numbers come out, and it's still only at 119 million. So in fact, over the last 3 years, it's been falling from 142 to 123 to 119 million in assets. So assets are actually falling, not growing, which is a concern, and generally just not something I like to see. I like to see growing companies where their asset base is growing as well. Looking at the long-term debt levels are fine. No issues there. There's no short-term debt now. They've managed to seemingly eradicate that, and certainly in 2019 they've managed to achieve that. And long-term debt sits at 26 million, so that's about 2 years worth of their earnings, which is absolutely fine. That's perfectly within their power to pay that back, and I would have no concerns over the size of that debt level. So that's all absolutely fine. Looking at the equity of the company, it has been growing. It's been a bit slow over the last 4 years, rising from 32 million to 47 million over 4 years. It's not been huge growth, but it's growth, and it's moving in the right direction again. And this is kind of the theme for this company, is that everything's moving in the right direction. It's just a little bit slow. It's early days, and they're not quite at the level of the company that I would want to invest in just yet. I want to see far better results than this, but it's all looking positive so far. Looking at retained earnings, that's been growing year on year, from 6.5 million in 2016 to 27.2 million. So they are definitely focusing and pumping money into those retained earnings, which is great. They're sitting on 27.2 million. It's not a huge amount of money. They're not going to be able to do a huge amount with that, but there may be some acquisitions they can do with that kind of money. Hopefully that's what they're putting it in for, because I like companies that grow in that way. They are intermittently buying back their own shares, but doesn't seem to be a huge focus on that. And the return on shareholder equity is very healthy. They are quite a big spender in terms of capital expenditure. Certainly spending about 3.6 million a year on intangible assets and property, plant and equipment. So they're obviously having to buy a fair amount of property, plant and equipment to compete. I prefer to invest in companies that don't spend too much on capital expenditure. But overall, we've got a company. If I was to kind of put this down into a nutshell review of this business, I would say that it's too early days for me to become an investor in this company. I've not seen enough evidence to suggest that this is a company that's going to be doing very, very, very well in the next few years. I've got other companies that I can invest in at this size that are showing better results, better figures that I've been more excited about. That said, everything's looking good in terms of it's moving in the right direction. And if they were to continue this, maybe in the next 5 years or so, we could come back and have a look at a company that's starting to really kind of knock on the door of a company I would want to invest in. So it's just a bit too early at the moment for me. Like I say, I've got other companies that I invest in smaller than this company that are already smashing all my numbers. So it's nothing to do with the size of the company. I'm not just not investing because they're a tiny company at 172 million a year, which in relation to a lot of FTSE 100 and 250 companies is small. It's nothing to do with that, because I invest in smaller companies that have got far better numbers in terms of their efficiency. It's not about the revenue they're bringing in. It's more about how efficient can they be with the revenue that they're bringing in. How efficiently can they run that business so they keep the most amount of profit possible. That's what I'm looking for. So it doesn't matter about the size of the company. It's what they do with it that counts, right? So let's go and take a look at the chart. Okay, so this is a monthly chart of the company, Luceco, or Luceco. I really don't know if I'm saying that right or not. Here we can see this big drop-off in December 2017, January 18. So interesting to know what that caused that. That's a fall from £2.40 by the end of January 2018. That's fallen all the way down to 72 pence from £2.40. And that may have something to do with that losing year, or a heads up by the company that maybe that year they knew that year was going to be expensive for them, or that expenses were going to go up and cause them to have poor results. Companies often release that ahead of time just to warn shareholders it's coming. It can scare investors off, especially with a company that's just begun to float on the stock market. Just a couple of years into them being on the markets, they're starting to announce trouble. Would scare a lot of investors off. But since then, they bottomed out probably November 2018, December 2018, where they went down to 35 pence a share. But since then, it would seem that we've seen some sort of recovery here, because the last few years, certainly the last year, has been very positive for this company in terms of being a record year for them since they've been on the exchange, for sure, in terms of results. And we've seen the share price now climb from lows of 35 pence a share, now sitting at £1 a share. So it's definitely moving up in the right direction. They've also recovered from the 2020 drop. So prior to the 2020 virus hit, where they were sitting at £1.40 a share, the share price fell all the way back down to 40 pence a share in March 2020. And then we've seen a pretty decent recovery up to £1 since then. So very similar with most other companies, but for me, £1 a share, this might be a good pick. This might be a good company to get into if you were willing to take a risk and you were hoping to get into a company cheap and early into their formation. Obviously, with this kind of company and these kind of financial results at this stage, you're taking a bit of a gamble, and you really want to understand this business as best you can before you start to invest in a company like this. For me, I already know it's a no-go for me, just because they don't tick enough of the boxes. I've got other companies I can invest in that are showing the same size, if not smaller than this company, but are ticking all the boxes and smashing all my numbers. And unfortunately, Luceco just don't do that yet. But it'd be a company that I would keep an eye on, keep a company that I'd be keen to track its progress. In 5 years' time, maybe we're getting in at £3-4 a share, and getting involved when the company are really starting to smash the numbers and do really well. But for me right now, there's not enough evidence in the numbers to suggest that the future for this company is great, and that they're smashing it, and that they're definitely going to succeed. I'm not seeing that yet, and so for me, it's keep an eye out. Let's go and take a look at the leaderboard and see how they scored. Okay, so yeah, I don't want to come across too harsh with these guys, because I actually really like them. They're a company that I'm going to be keeping an eye on in the future for sure. I like the products that they do. I like the industry they're in. And financially, they are close. They're not a million miles away from being one of those companies that do tick all my boxes, but they're not there yet. And so it's a company I'll be keeping an eye on. About £1 a share right now, so price is quite low. Looking at the underlying value of the business, The EPS score is the EPS that they're making is 8.3 pence per share, which if you're buying them at £1 a share gives you an 8.3% return on that. So that's pretty good. If you were to buy all the outstanding shares at £1 a share, which will cost you about 160 million, you'd be making 8.3% return as the owner. So you'd be pretty happy with that as an investor. Looking at the equity, they've got about 47 million sitting in equity, which works out, if you split that up over per share basis, you're looking at about 29 pence a share. So the fact that you're buying shares for £1 and 30 pence of that, you've already just accumulated the assets. I think that's fantastic. So what that indicates to me then is that a fantastic price to buy this company would be about 80 pence to £1, and we're sitting at £1 now. So I would say that £1 is a fantastic price to get into this company. A good price would be anything from about £1 to £1.30. That is the pricing, and that is entirely separate to whether you should invest in this company, if that makes sense. You've got to join the two together. So are they financially sound? Are they ticking all the boxes from a financial point of view? And if they are, you then look at the price and say, does the price make sense? And the two have to match. You have to have a company that are fantastic financially, that are growing, that are doing everything right. And then once you've found those companies, you've got to find within those companies which ones of them are trading at a price that's realistic to their underlying value. Luceco, however you want to pronounce it. Maybe you can leave me a phonetic explanation in the comments. But pricing wise, great, fantastic, great price to get in. Financially wise, they're just not quite cutting it. And that's a shame, because if they were, then this would be a great time to get into them personally. And that's only my personal opinion. As in all of these shows, it's always my personal opinion. I'm not a financial advisor. I'm not qualified to give financial advice. I'm only sharing with you guys what I would do, what I plan to do, the decisions that I'm making for my own investments. You can use that information to do what you will with it. But that's essentially what I do on this show. For entertainment purposes, I'm just sharing what I'm doing. But for me, Luceco, no good. Not quite cutting the mustard. Let's get them up on the board. Okay, so LUCE is the EPIC code, and the score. So last week we had WH Smith. They scored 59 points. I felt that was absolutely fair for the numbers that we looked at. I think here we've got a very similar company, nowhere near as big as WH Smith. I think WH Smith were trading at about 1.7 billion. Luceco, something like, what was it? I can't even remember now. 50 million, something like that. I can't remember. Maybe 170 million. But the score is very similar, 61 points. And I think that's absolutely fair, because again, we've got a company like WH Smith, whilst they're very different in size, are just as efficient and making the same kind of returns from a percentage basis. So yeah, I think that's absolutely apt. They just pipped WH Smith by a couple of points, not much in it, but let's get them up on the board. Okay, so up there, just pushing WH Smith down by a point, sitting in 10th place. I want you to take a look at that board just for a moment and look at the different names, because this, I think, paints a kind of a picture. We're 36 episodes into this show now, and some of the big names, the big companies that the beginner investors tend to flock to, are all down the bottom. You know, we've lost Rolls-Royce. Today, we lose Centrica, another company that everyone seems to love, but just nowhere near good enough for a long-term investment. We're looking at BP down there, Vodafone down there, Tesco down there. These are all really common stocks. Now look at the top. Look at Diageo, pretty big company, but Taylor Wimpey, Bodycote, Greggs, Intertech, Sage, Treat PLC, a chemicals company, Luceco, the lighting company, WH Smith. These are all smaller businesses, all smaller companies that aren't anywhere near as popular amongst investors. Some of those companies you probably never even heard of before watching this show. And I think that is testament to the fact that you really cannot go on the name or even on the brand. You really need to do your research and look at what these companies are actually doing before you invest. Thank you so much for watching, guys. I hope it's been insightful. I hope it's been useful and even entertaining, maybe. It's hard to make stocks entertaining, but if you share the love for this stuff like I do, then hopefully you'll be enjoying this show. If you are, please give this video a thumbs up, and thank you very much for watching. Cheers, guys.